시청자도 네, 입장하셔서 이제 착석해 주시면 감사하겠습니다. 해운 항만 세션 1, 2 이렇게 준비가 되어 있고요. 첫 번째 세션은 건화물선 시장 동향과 전망을 주제로, 그리고 이어서 유조선 시장 동향과 전망을 주제로 말씀을 주시고, 역시 한 10분 정도 휴식 시간을 갖고 나서 해운 항만 두 번째 세션을 이어가려고 합니다. 첫 번째 해운 항만 세션 두 분의 연사께서 준비를 해주셨고요. 약 30분 정도씩 말씀을 주시겠습니다. 해운 항만 세션 시작해도 되겠습니까, 여러분? 네, 고맙습니다. 10월의 마지막 주이고요. 이번 주도 11월과 교차를 하는 주입니다. 정말 완연한 가을이 우리 곁으로 다가온 이 10월의 마지막 주, 다들 아마 바쁘실 겁니다. 이제 2024년도 2달밖에 안 남았어요. 네, 각자도 계획하신 일들이 2024년에 잘 원활하게 잘 진행이 되었는지 모르겠습니다. 오늘 이렇게 소중한 시간 함께해 주셔서 감사드리고요. 내실 있는 주제와 해운 항만 물류 산업의 성장과 발전을 위한 논의의 장으로 함께하고 있습니다. 2024년 함께하는 KOBC 마리타임 컨퍼런스 해운 항만 세션 첫 번째 세션부터 모시도록 하겠습니다. 먼저 건화물선 시장 동향과 전망을 주제로 말씀 주시길 예정입니다. SSY의 글로벌 리서치 책임자십니다. 로어 아들랜드님을 여러분의 박수로 모시겠습니다. 큰 박수로 맞아주시기 바랍니다.
Thank you very much for the introduction. It's always challenging to know when to go on stage when you don't know the language, but I think I managed. So I have the pleasure of trying to entertain you after a lunch break and a coffee break, and I hope you're all settling in well. So my name is Adland. I'm the head of research at SSY, and it's a pleasure to be here at the KOBC. I have been to Busan prior, it's about 20 years ago. And it's very nice to be back, and I thank you to the KOBC organizers and the conference organizers for the invite. Now, in the next 25 minutes or so, I will walk you through the view that we have at SSY, in also the dry bulk market outlook. And now, in doing so, I will give you some forward-looking statements. I will show you some forecasts, and as you know very well, it's very hard to forecast the shipping environment and the shipping markets going forward, and so my opinion is likely to be wrong. So as this small print says, I'm not going to go through that, but please don't rely on my opinion, please don't trade on it, and certainly don't try to sue us afterwards. Now, even though it may not feel like it, actually shipping in general and dry bulk markets in particular have had actually quite a good run. We've had about 12 months of what we call following seas. How did I say that? Well, we've had very strong growth where it matters, so very strong Atlantic cargo growth coming into Asia. We've had record high dry bulk imports, so record high bauxite, iron ore, coal, soybeans, you name it, going into China. And that's despite really all the macro headlines about how poorly the Chinese economy is doing. Now, on top of that, we've had a bit of spice, as I like to call it. So we've had the rerouting in the Panama Canal over the kind of transit restrictions that we've had there. We've had the Red Sea rerouting and the attacks over that. And that has really given us quite strong demand growth overall, if you look at ton miles, as we do here in these graphs. Now, it's been a very good year, as I said. This shows the year to date, so actually through August, year-on-year growth for demand growth, ton miles by segment. So Capesize, VLOCs on one hand, up almost 8% year-on-year versus the same period last year, really very strong. Panamax is similar, about 8.6%, and Handymax is 6.5%, and Handysize is about 3.9%. Now, the interesting part here, as you will start to notice, is of course that a lot of that growth was really front-loaded. So the first quarter of the year was very strong, and it's kind of tapered off a little bit since then. The other interesting point to notice is that, of course, Handysizes being the smallest vessel size, they have not been as affected by any of this, and of course they are regional traders anyway. So whether there is disruption in the Suez Canal or Panama Canal, that maybe does not have such a big impact. Now, if we look at this in terms of time, so if you look at ton days demand growth, so if we look at the share that a vessel spends either waiting to load in port, sailing laden, or discharging, then that ton day demand growth is a lot less. So you can see some of the comparison here. For Capesizes and VLOCs is down to about 3.4%, so almost a third of the apparent ton mile demand. Panamax is about half, so 4.6% year-on-year, year-to-date, and Handymax is still a solid 5.7, etc. So why do we see this difference between ton miles and ton days? Well, there's been this kind of offsetting effect where port congestion has declined throughout 2024 and it's remained rather low for the year. Now, that has then had this offsetting effect in terms of time. So you can think of it as having higher fleet efficiency or indeed higher port efficiency. So demand has been good, but not breathtaking, I would say. So 3.5%, 4%, it's certainly very good, but of course we also have to keep in mind where the supply growth is, and that's a problem that we'll come back to. Now, if we've had this very strong demand growth then, and if Panamaxes are currently struggling with average earnings, spot earnings of about $9,000 per day, what does that really tell us about the state of the market? Well, I think it's fair to say that maybe some of our luck, that the luck that we have in the last year, maybe some of that luck is about to run out. Some of those tailwinds are gradually moderating and they may be turning into headwinds. And so we will have a look at that. Now, what are the 6 things that we like to watch at SSY for the dry bulk markets in the next 6 to 12 months? Well, it's really more of the same. It's still going to be about the Atlantic cargo volumes. How much are we going to see coming out of there and into Asia? It's going to be about Chinese coal imports, which has surprised us to the upside, and maybe they will continue to do so. It's, of course, all about the Chinese steel market, and we talked about stimulus packages in the last couple of hours, and of course, that is going to be very important for that market going forward. How about weather? So you probably heard about the El Niño and La Niña weather phenomenon, and that is changing. We're now moving into a La Niña state, and that's going to have an impact also on the dry bulk markets. How about the canal disruptions, the Red Sea, the Panama Canal? Will that stay with us or will that dissipate as well? Now, the interesting thing on the supply side is not really that supply growth is low. It's actually, I would say, average and it's stable. And it's going to be stable at around 3% fleet growth in deadweight terms, also going into next year. The interesting part is that it's so different between the segments. So Capesize, yes, doing very well, but actually fleet growth on the smaller sizes, the geared segments, it's actually very, very high. So let's look at some of those drivers in a bit more detail. So you can see here on these graphs the weekly exports of Brazilian iron ore and Guinean bauxite year to date and comparing with last year, and also the range that we have in the last 3 years. Now, it's been a very good year, as I said. We estimate that Brazil iron ore exports year to date, so basically through last week, that was up 6.6%, and that's another 18 million tons of cargo, which is quite substantial, and it's all, of course, all Capesize, or really mostly Capesize. Now, interesting to note, though, that most of that outperformance came in the first quarter of the year. where we had about 18% increase in volumes. And if you look at it since April, that has moderated quite a bit, and we're now down to 3.1% since then, and we expect that to continue to decline into the end of the year. Guinea, so bauxite into China mainly, about 90% of the bauxite being mined there is actually going to China. That's another sunshine story, I would say. Another 15 million tons of cargo only there. That's, of course, a 16.5% because the base is lower in terms of growth. That is lower than the kind of 20% plus growth that we saw last year in this region, but it's certainly still very high. Now, an interesting point here is that we're starting to see a bit of a cannibalization from the very big ships. So the VLOCs, they're increasingly taking a lot more of this export cargo. And so if you look at it from a count of cargo, standard Cape-size cargoes, then that growth is a lot lower at about 9%. Still, we're quite optimistic here. We think that these operations are so profitable. The bauxite and aluminium market in China is very tight. CFR prices for bauxite still going up. Hydropower production is certainly encouraging that we have a bit more alumina smelting. And so we expect that anything here that is mined will also be shipped. But however, we don't expect that the growth rates will stay as high as they are at the moment. We expect and are currently modeling about 2% growth in Brazilian iron ore exports next year, and then maybe around 6% growth on the bauxite. So demand growth is coming down. There's no doubt about that. Now, Chinese coal is another interesting story for the year. I think we came into this year thinking that imports would come down. That has not been the case. Actually, imports, or I should say seaborne coal imports into China are actually up almost 10% year to date through last week. And that seems to be going strong also going forward. Now, there's a couple of reasons for that. The arbitrage, the kind of price arbitrage for coal imports into China has been open for the whole year. The seaborne global coal market is still oversupplied. We expect that to continue, and so the coal is cheap, and we expect China to continue to buy it. The other interesting part is that actually hydropower production, or the potential going forward for hydropower production, is not as great as we thought. Yes, it was a very strong start to summer rains, but August and September precipitation was actually very disappointing. And as you can see in the upper graph there, currently the dam level in the Three Gorges, which is the kind of key hydropower production center in southwest China, the dam level there, and therefore the potential for hydropower production is actually below what we've seen in the last 10 years. So we do expect for that reason that Chinese coal imports will keep up on the high side. There's a lot of talk about restocking also, but as you can see from the lower graph there, really coal port stocks in China are not particularly high. Well, they are high, but they are stable, and they have been stable for the past year and a half. So all in all, we are quite optimistic on China in terms of coal imports for next year, but there are declines in other parts of the global economy, certainly going into the EU, such that overall, from a global ship demand point of view, we are currently modeling flat demand growth on the coal side. There's been a lot of things said and written about the Chinese steel market in the last year, and certainly in the last couple of months, given all the stimulus chatter and news coming out of there. Now, the interesting part here is that we don't really see that trade flows are going to change because of it, at least not in the short run. as you can see in the upper graph there, which kind of shows that very volatile, kind of short-term Chinese steel market cycle. Yes, the stimulus package certainly helped. If we go back a couple of months, then only 2% of Chinese steel mills were actually profitable. Now, because of steel prices going up and sentiment having been improved, and therefore profitability going up, that at the moment actually 2/3 of the Chinese steel mills are once again profitable or thereabouts. That is a big improvement, but it's also just part of this kind of short-term cycle that we've seen many of in the last few years. But we do think, or rather, we do think that the Chinese stimulus packages has helped is that it has removed some of the downside. That's important. Now, we were actually quite constructive on Chinese steel demand coming into this year. Yes, the property market has been weak, but it's been weak for 3 years running, right? So it's not. So it's now a much smaller part of overall Chinese steel demand. So whereas it was about 1/3 of the overall steel demand going into the property market, last year, and at the peak of the market, it was maybe 40%. So it's now a much smaller part of overall steel demand. And really all the other parts of that, really all the other sectors that are driving steel demand in China, whether that is advanced manufacturing, shipbuilding, car production, defense spending, etc., really all of those sectors are doing very, very well. So overall, we are kind of modeling this as stable. We don't see any large downside risk anymore. We think the kind of response from the Chinese authorities has kind of helped stabilize the situation. It has indeed helped benefited sentiment, but at the same time, we don't really see that translating into higher trade volumes either on the steel or on the iron ore side. So stable as she goes. But of course, if there is any increase in ship demand, that would then have to come from a further kind of substitution effect, where there's less domestic iron ore production, less Indian exports, but then more long-haul sources. Now, you probably heard about the El Niño and the La Niña phenomena. So that has to do with the sea temperatures in the Pacific Ocean, and it actually has quite a big impact on global weather patterns. So up until May of this year, we were in the so-called El Niño state, and that was largely bullish for ship demand, dry bulk shipping in general. We had, among other things, kind of higher temperatures in India. We had a very weak monsoon season, and that, of course, led to higher coal imports at the end of last year and into this. It was very positive for Atlantic grain export into Asia because Australia had droughts. And it also gave us the Panama Canal restrictions that we saw coming in at the end of last year. Now we are no longer in that El Niño state. We are somewhere between neutral and La Niña. And as you can see there on the right-hand chart, the blue bars show the probability that we are now in the La Niña state. And as you can see at the moment, that probability is about 60%, and that's increasing to about 80% at the end of the year. Now, even though we are in a so-called neutral state, or at least just about to change into La Niña once again, the weather has, in a way, been more akin to what we expect with the La Niña episode. So we had a very heavy Guinea rainy season. So in July, August, September, Guinea saw 50% more rain than they did last year. We also had a very strong Indian monsoon, which meant that, of course, we have had higher hydropower production in India, and therefore, actually also lower temperatures, and therefore lower coal demand and lower imports into India in the last couple of months. Now, once we do see this change into La Nina condition into this quarter and into the beginning of next year, then that will have an impact, or it might, I should say, have an impact on exports, primarily in terms of Indonesian coal exports at the very end of the year, and maybe Brazilian iron ore exports, and also Australian coal exports at the end of the year and into the first quarter. But this seems to be quite a long, quite a short event. The last La Nina actually lasted 3 years. For the time being, this only seems to be going on for the next 6 months or so, and so maybe the impact overall will not be as great. What about the canal disruptions? Well, I talked about how El Nino, La Nina has an impact on Panama Canal. And now, the good news, I suppose, is that the Lake Gatun, which is feeding the Panama Canal, that is now back more or less in terms of normal water levels. That means, of course, that the restrictions in the Panama Canal have been gradually lifted, and we do expect that the last of those will also be removed by the end of the year. Now, as you can see on the upper graph there, in terms of number of transit, we are certainly not back to where we were a year ago. We are gradually coming back, mostly on the geared side of things. So there's only geared vessels going through, at least laden. There's a few Panamaxes ballasting through, but I've not yet heard of any laden legs going through there. Now, the interesting part, I guess, is whether we will see structurally lower level of transits or bulkers going through the Panama Canal over the next year. The main reason for that is that now all transits have to be pre-booked or actually bought as slots during auction. That could, of course, mean that some of the cargo, which is kind of marginal cargo anyway, because of that higher transit cost or because of that loss of flexibility, that some of that cargo will be squeezed out. So we could see kind of a return, but not to the previous levels, certainly that we saw at the end of last year. Now, in terms of Suez transits, that seems to be stable. We are down 60% from the average last year. That's a situation that has been stable since about May of this year. Now, our base case here is that we don't see any change, that this will stay with us. This Red Sea rerouting will stay with us for the next year. But of course, we cannot exclude that there will be some sort of a political or military resolution to this issue, in which case, of course, there's more downside to shipping when all that rerouting, all that additional sailing distance will actually disappear once again. The interesting part, as I said, on the supply side is not really that supply growth is low. And I kind of noted that some of the earlier speakers are still talking about supply growth being low or the order book being low. Well, that's not really the case anymore. Supply growth overall in deadweight terms was around 2.9% last year. It will be about 3.1% for this year, and we're looking at a similar number of 3% also next year. The interesting part is that it's so different across segments. So yes, Capesize fleet growth is low, absolutely. We're estimating 1.8% fleet growth for this year, and that will stay 1.7% for next year, 2025, and also maybe sub 2% in 2026. Panamaxes, though, are, I would say, above average already, 3.5% for this year and increasing. And the real problem is in the geared sizes, the smaller vessels, where fleet growth for this year on the Handymax is actually as high as 4.6%, almost 5%, which is the highest we have seen really for several years. So I think I'll try to paint a picture where we've had a good year, but some of those tailwinds are now gradually turning. And while it might not be kind of head waves or headwind just yet, I think that time is coming, and it's probably coming next year. So we're expecting moderating Atlantic growth on the cargo side. We are seeing gradually normalized trading patterns, particularly in the Panama Canal. And we're actually seeing very high supply growth, really everywhere, except on the Capes. So that brings me to the kind of outlook from SSY point of view. You can see our estimated supply and demand growth numbers by segment for next year in the lower table there. And as you can see, compared to this year, there's a lot more red kind of downward pointing arrows. And that suggests that we have a weakening fundamental environment. So seen in isolation, Capes look okay, maybe even strong. But of course, the problem that Cape sizes have is that they don't live in isolation, right? They are impacted by the weaker fundamentals for the smaller sizes. So what we have seen so far this year is that whenever Cape size rates come up to a certain level, where people start talking about splitting cargoes into Panamaxes, then that is enough to kind of bring the Cape size rates down again. And we're seeing a lot of the coal in particular moving from Cape sizes and into the smaller sizes. Now, we expect more of that to happen next year, so that we have kind of Capes being stuck in this trading range, and also therefore that cap being lowered as the fundamentals of the smaller sizes get worse. Now, I kind of mentioned already that there are downside risks even in this scenario. There is certainly, if the Suez transits were to come back fully, that would be further, deteriorating the situation. There is also upside risks, of course. Certainly, scrapping could be a lot lower than what we have in our numbers. As you can see here in this graph, we are still expecting very, very low demolition numbers going forward. Now, if we have a period of poor rates, of course, in the next year, then that could hopefully encourage a bit of scrapping, and therefore that could improve the fundamental situation compared to what we are suggesting here. But still, our outlook is for weaker fundamentals overall for the segments, and a Cape continued tug of war, if you will, between a stronger Cape size market and weaker, smaller sizes. So that's it. That's what I have for you. I hope you find that useful. Thank you very much.
네, 고맙습니다. 건화물선 시장 동향과 전망을 말씀을 해주셨습니다. 세계적인 해운 중개 업체 우리 SSY의 글로벌 리서치 책임자 로얼 안들랜드님께서 연사로 수고해 주셨습니다. 다시 한번 진심으로 감사드립니다. 해운 항만 세션 첫 번째 세션 함께 나누고 계시고요. 작년에도 연사로 수고를 해주셨는데 올해도 이 KOBC 마리타임 컨퍼런스에 함께 해주셨습니다. 두 번째는 유조선 시장 동향과 전망을 말씀해 주시겠습니다. 맥큘링의 책임 연구원인 올리버 겐님께서 발표를 준비해 주셨습니다. 여러분 큰 박수로 맞아주시길 바랍니다.
Thank you very much, and thank you KOBC for inviting me to this year's event again. I do have to say the tanker market has been experiencing a lot of the volatility factors. We have still two wars happening in the world. We have US election happening next Tuesday. And we have a lot of infrastructure projects that just came online and several ones are coming online next year. We also have economic concerns that has been covered in the morning session. So this time, what I want to show first is our long-term forecast, in the very beginning. So in short, our tanker market earning forecast, especially for the dirty segments, which means crude oil and deep fuel oil trades, will see continued strengths going into 2026. While some of the new ships being ordered are delivering, so that will pressure the earning level lower in 2027 and 2028. For the refined product, for LR and MR segments, because of this prolonged new ships ordering activity, we do think that the earning will trend lower. So now let me explain why. One of the ways when we look at the market has been looking at the demand and supply market fundamentals, especially on the demand side. There's a unit that was being used for measuring the demand. It's called ton-mile demand. I do find this unit to be a little bit less useful these days because it's not so accurately, first of all. Secondly, not very easy to read, right? So what we did here is we convert the tanker demand into demand equivalent. That means how many ships you need to transport those cargoes from region A to B. So we take into account the sailing distance, the speed, the port turnover, the delays. So everything is included in this unit. So if we compare for each of the vessel segments, we can see that the strengths that we expect in the VLCC, especially the VLCC, the largest vessel class, has been driven by the demand side. If you see this orange color in 2025 and 2026, on the year-over-year basis, it will add approximately about over 100 vessel demand equivalent during the 2 years. Well, if you look at the smaller vessel classes or the refined product side, the major impact has been on the blue side, which is the supply side of the equation. That is mainly due to there's a lot of vessels being ordered. So you may ask why we are so bullish on the VLCC segments. The main reason is that we think the crude prices will be flipping very soon from the current backwardation structure to contango structure. So let me explain what is contango. So contango means that the future prices are expected to trend much higher compared to the current environment. We know in the current environment, crude oil prices has not been performing pretty good. I think this morning when I was reading the news, the crude oil, global oil, has been down by about $4 per barrel. So that is showing how weak the fundamental has been performing. Why we are bullish on the forward end of the curve could be shown on the left-hand side. When US Fed continuing cutting the interest rate, when we look at the historical patterns from 2002 to 2012, the US interest rate have a reverse correlation to the oil prices. What I mean by that is, I use the Japanese yen to US dollar. So if we see this blue line, which is trending lower, that indicating a weakening US dollar, that will translate into a higher crude oil prices. It also makes sense on a fundamental basis. So if you think about crude oil is priced in the US dollar. So when the US dollar is weakening, that means for other countries, when they are purchasing the oil, the price that was measured in the US dollar will get higher and higher. So that will create this kind of flipped structure with front end being pressured as we're living right now, but forward curve will be supported on the pricing. Why the contango structure is so important and beneficial for the oil tankers is that this kind of contango structure will trigger global restocking. Global restocking is very, very important for the oil tanker market, especially for crude side. At the moment, global crude inventory, as we know, has been remaining at a very low level, about 35 days of forward demand coverage, while global crude oil demand is around 83, 85 million barrel per day of the levels. But before the COVID time, on average, the global inventory level should be able to cover around 40 to 60 days of that very wide range of the demand coverage. So what that means is, just aside from the oil consumption, just for the restocking purposes, we are going to see at least about 3 million barrels per day of demand support that is going to help the tanker market. Another very important factor is about OPEC. We know OPEC countries managing this global crude oil flows and crude oil production targets. I think OPEC country has been making a very, very good decision to not flood the market with crude oil at this time. Because if you think back, previous to occurrence, if we look on the right-hand side, I highlighted the past 3 contango structure on the crude oil prices. The past 2 occurrences are policy-driven, which is a supply-driven contango. Those contango structure, although very short-lived, has pushed the oil demand and crude oil demand very quickly. However, the OPEC countries continuing losing their market share to the other producers, including US, including Guyana, Brazil. Those countries has been rapidly increasing their crude oil prices. So it seems like OPEC is not going to win by a rapid change of the crude production targets. So what we think this time is very different from the last 2 occurrences, is we think that this time the contango structure will be similar to the level we see back in 2005 to 2011. So in the first red box over there. You see how long and how many years it actually lasts for this crude contango structure to benefit. So that marks as one of the key impact that we think the VLCC market will benefit. On the refined product side, on the CPP market, I think the major challenge has been the new ships being ordered. If we look back into how many vessels has been ordered in the oil tanker space, last year, 2023 alone, we had 105 MR2 vessels being ordered. That number is already the peak level we saw since 2014. So that is really a record-breaking levels. But how many ships we're seeing so far this year? It's already reaching 180 and is on track to reach over 200 vessels to be ordered in 2024. So that marks one of the biggest challenge in the refined product tanker market that we think that the earnings will adjust it down in the future. Another very important element for the refined product side is creative ideas from oil majors and oil charterers, is we have seen a lot of the uncoated VLCC and Suezmaxes participated in trading refined product, mainly carrying diesel cargo from the AG, which is the Middle East, and also India to the Western destination, including Europe and Africa. So if you look at the orange bars, that represent how many spot fixtures we have captured from uncoated VLCC on the left and uncoated Suezmaxes has been carrying the refined product. That serves as a very big downside risk, because imagine how many MR cargo that is cannibalized, the demand has been cannibalized by those large tankers. The 2 major players for those cargoes has been Trafigura, which is oil traders, and Reliance, which is the Indian oil company. We don't think this kind of trend will continue in the following years or 2, because it's purely a money play, right? Because the VLCC, Suezmax are being much cheaper compared to LR2 due to this Red Sea situation. I know this is a very hot topic about the US election, and from a US company, I seem to not be able to skip this subject in my slides. Well, what we say is called history doesn't tell the future, but it rhymes. So what I did here is, if you look on the left-hand side, I highlight the period of time when we have a Republican US president or when we have a Democrat US president. What's the impact on the global crude oil prices as well as the production level on the global basis? It actually matches with our expectation very well. When we have a Democrat US president, the oil prices will always be supported, while crude production level will benefit when we have a Republican US president, meaning Trump. So I think it makes sense because, on the left-hand side, when the Democrat president is in the House, they want to support the ESG, the renewable energy projects. In order for those projects to work, we need to have a high oil price environment. So that explains the reason. Perhaps more interesting is on the right-hand side, the 2 tables. So What we did is we looked back into the past 6 occurrences during the election year. What is the oil tankers earning on average on annual basis versus the following year? So in these circumstances will be 2024 compared to 2025. For the VLCC vessel classes, all 6 cases has indicated a year-over-year decline on tanker earnings. While the clean market, I use the LR2 as a benchmark, most cases is also indicating a year-over-year decline. This time may be a little bit different, but it matches with our LR2 tanker earning forecast that 2025 on average could be slower, or let's say less on the TCE level, on the TCE basis for the clean vessel segments. Another big impact, there's a lot of events happening in the oil tanker market. Another impact we have been looking at has been the Red Sea situation, or let's say Middle East tension, and their impact on the oil tanker demand. On the cruise side, if you look on the left-hand side, there are some bypass that you can navigate through this choke point. It's used Saudi's east to west crude oil pipeline and connected with Egypt's Suez pipeline that can bring the crude directly from AG to Mediterranean and then going further to European market. But on the refined product side, if you look on the right-hand side, there is no such bypass, which means oil tankers on the refined product side, over 50% of them has been rerouting through the Cape of Good Hope. When measuring this on the AIS maps, you can see it's very clear pattern difference from 2023 to 2024. So a lot of the vessels, if you look at the red dot, which represent the VLCCs, has been taking a lot of those kind of AG, Middle East to Europe oil flows by using the bigger ships. So VLCC has been taking a lot of the mid-sized tanker demand, as we see. On the west to the eastbound, very similar stories, but what you can see is Aframaxes has not been rerouting through the Cape of Good Hope. There are a couple of reasons behind it. A lot of the Aframax demand that load in Russia and go into India has not been rerouting through the Cape of Good Hope. The main reason is India is taking the Russian oil on the delivered basis. So it's up to the ship owner's decision to reroute or continue taking the risk to go through the Red Sea choke points. So that is a pattern we have been looking at. In measuring the demand side impact, initially we were thinking VLCC could trend lower on the year-over-year basis, but indeed it actually trend much higher because VLCC become a suitable tonnage to cannibalize those mid-size tankers to go through much longer distance through the Cape of Good Hope. On the refined product basis, it's not benefiting as what we are anticipating. The main reason is rerouting through the Cape of Good Hope on LR2 has made the freight structure much more expensive. So for the European market, instead of importing diesel cargo from the Middle East, they have been importing a lot from the US. So that is supporting this MR2, the smaller vessel class demand, instead of the LR2 demand. So now the question becomes, what will happen next? We're either going to see a tension escalate or tension easing. So we made 2 further scenarios in our study. Let's start with some positive anticipation to see if the tension eases, what will happen. In this scenario, we could see that the Red Sea choke point reopens and tankers continue to go through those, the Suez Canal and also the Red Sea. In that regard, VLCC and Suezmax demand will go lower. Aframax demand, on the other hand, will be supported, which means that the mid-sized tankers demand will be supported. On the right-hand side, which is the refined product sizes, all 3 vessel classes are expected to experiencing a slowing demand on that perspective because of much shorter sailing distance, about 34% to 35% reduction in the sailing distance. In the tension escalate scenarios, which is very interesting because I created those scenarios back in December 2023, just add that into something funny to interesting to look at. But seems now looks like there could be a potential case to have the Hormuz Strait closure. there are not a lot of bypasses that we can use. They are something I mentioned earlier, Saudi's east to west pipeline. There's another pipeline in UAE, which is called Abu Dhabi pipeline. Currently, 40% of the capacity is being utilized, but just those two pipelines, a total, if you sum those up for the unused capacity, it represent about 3.8 million barrels per day of demand. However, the total oil that goes through the AG, that goes through the Hormuz Strait, reaches over 13 to 15 million barrels per day of the flows. So the world needs to replace those additional crude supply from the market. So if you look at the graph on the table from the left-hand side, you can see that the 3.8 million barrels per day on the blue, that represent this potential bypasses, while the others, 1.42 million barrels per day, could be fulfilled by the inventory drawdown, while the other side, the orange side, will represent that the oil that need to be replaced by other sources, including U.S. shale oil. But all in all, if we are going to encounter those kind of scenarios, it's going to be a very big disaster because crude oil price, first of all, are going to reach out to $200 per barrel. Right? So that will not be sustainable kind of method that the world is expecting. Some other infrastructure project, which I always say it's very interesting and very worthwhile to look, is the Americas market. There's a lot of potentials, especially on the oil side, in the Americas market, including North and South America. Let's start with the US. There are several infrastructure projects happening in the US Gulf to build VLCC terminals. So at the moment, the most common way to export the US crude is to load about 1.2 to 1.4 million barrels at Corpus Christi, which is located on the left-hand side of the map. And then you go to these offshore loading areas to use one Suezmax to top up the VLCC, and that VLCC will be exported to destination including Korea. So with those infrastructure projects, have the VLCC terminal project, VLCC can load directly 2 million barrels at the terminal itself before going to the other regions. So we're saving the charterers, saving the oil companies the cost to do the lightering services. We used to have over 10 projects. As you can see, a lot of those projects has already phasing out. The 4 remaining one, I would say, the most promising one will be Enterprise Spot Project, SPOT project. That project has already received the offshore terminal license to build, but they are still debating whether they want to invest the money in to start their construction. Our expectation is, I'm noting here, say 2027, but likely to be postponed a little bit later to 2030. But that will definitely change the overall dynamics in the Atlantic Basin for the oil tanker market. VLCC will become a very major, I would say, a major vehicles to export the US crude in the future. Another region is Canada. I think I mentioned that in last year's KOBC conference as well. This pipeline actually completed and start exporting a lot more Canadian crude since mid of this year. This pipeline capacity increase about 590,000 is expected to reach the full capacity for about to add additional 590,000 barrels per day of export from the Port of Vancouver. Our consulting engagement can be traced back since 2022 when we provided this independent consulting project for one of the equity holder for the pipeline. In that time, when we are trying to see where the crude could be flowing, we created several scenarios to export the crude to the US West Coast, to export the crude to the Far East. But one of the scenarios we created here is to use the ship-to-ship lightering scenarios to fully take advantage of a cheaper VLCCs before they go to the Far East regions. So the lightering areas we proposed here are 2 lightering areas. One of them, I think many of you have very familiar, is the Pacific Lightering area. That area is located just next to the Long Beach and the Los Angeles area. A lot of the vessels were deployed there. Another region we were expecting is in the West Coast, Panama, which is a little bit south on this map. In short, actually we believe more volume will be ship-to-ship lightered in West Coast, Panama instead of Pacific lightering area. Here are a couple of reasons. First of all, the Pacific lightering area is a very challenging water to do the ship-to-ship lightering. The weather delay, the instability of the wave serve as a very big potential cost element for the charterers because, delays always means demurrage. Demurrage means more cost to the equation. Second of all, there's not a lot of lightering service company in that region. There are only 2 at the moment, with Safe STS expecting to add another, become the 3rd lightering service company in that region. Well, compared to Pacific lightering area, West Coast Panama definitely have much calmer water. And it's already a very highly developed lightering area for a lot of Chinese players, because Chinese players, what they did is they bring the crude from the Trans-Panama Canal, including Colombian crude, Guyanese crude, that goes through this pipeline and then load on the VLCCs. China Merchant, AMCL, is a very big player in this market. So when comparing different scenarios and when comparing the freight structure, how high the market could be supported by the Canadians' TMX project, we have listed the dollar per barrel type of freight consideration on the left and right-hand side. Ship-to-ship lightering definitely is going to save charterers a lot of money. However, if you look on the right-hand side, I put a dotted line on top of the green line. That means when we have more delays, when either one of the Aframaxes are experiencing 1 day of delays, this kind of savings on freight structure following this ship-to-ship scenario will be significantly reduced. So that serves as a potential risk for the VLCC freight structure here. Another very big element in the Americas market, in my view, is Guyana. Guyana is a small country located just right above Brazil in Latin America. Guyana oil fields are currently controlled, or let's say owned, by 3 companies. ExxonMobil hold 50% of the share, Hess hold about 30% of the share, and Chinese company CNOOC, CNOOC, hold another 20% of the shares. You may hear from the recent news that Chevron is in the midst of a discussion to buy Hess. So in the future, when we're talking about 3 companies, we may talk about Exxon, Chevron, and CNOOC in the future. At the moment, how the Guyanese crude are being exported out through a couple of approaches. During the, I would say, summertime, most of the crude could be carried by VLCC vessels and Suezmaxes to be exported directly to Northern Europe, which is a very big market for Guyanese crude. The main reason Northern Europe refineries really like this crude is because it's a very light and very sweet type of crude, which means very limited sulfur content in this crude grade. About 45 to 50% of the crude also goes through this Panama pipeline and then to be loaded on the VLCC, as we previously mentioned, then going to the east. That is another approach of how the Guyanese crude are being exported. In the future, this is not happening at the moment, but we do believe some new trade routes is expected to be formed. First of all, on the West Coast, we expect Guyanese crude to flow to West Coast Panama, and instead of being exported directly to the Far East market, it could be blended with the heavy Canadian crude coming from the TMX. So if you see the dotted green line, that Aframax is expected to go all the way to West Coast Panama to deliver this heavy crude and blend with the light crude produced in Guyana. We expect this kind of crude grade will be similar, the blended crude grade will be very similar to the Arabian median, which is a very common crude grade among the world. The crude could be continue heading north and go to the US West Coast, but it can also go on the VLCC and export it to the Far East market. So that is one of the potential trade routes that we believe is going to form in the future. This will introduce also impact on this TMX story I mentioned earlier. The reason is when the US West Coast refineries going to take more of those kind of crude grades, it will push out Middle East crude that normally arrive on the VLCC on the West Coast Americas market. What does that mean for the VLCC market on the West Coast? Is that we will see less naturally positioned VLCC in that region. So in order for charterers to export Canadian crude on VLCCs, the freight structure will be different because it just the freight rate needs to be high enough to attract those VLCC with ballast from the Far East to the West Coast Americas market. Another trade route we think is likely going to develop is to utilize a storage terminal in St. Lucia. St. Lucia is also another country, but it's a very small island, about 300 nautical miles north of Guyana. That St. Lucia port or the country have a very large oil storage facilities, about 10 million barrel of crude storage facilities. Why we think St. Lucia could be very important, very like a new trade route that could be developed, is because as we mentioned earlier, Guyana have a window from September to January, no VLCC allowed to load in that region. So majority of the demand returned to the Suezmaxes during those months. What happened in St. Lucia is that the water condition is much different compared to Guyana. So what you can do is you can use a Suezmax tanker just do short-term lightering services from Guyana to St. Lucia while you load VLCC directly in port in St. Lucia. In that regard, it will reduce the cost, it will reduce the potential delays in this loading activities. So in short, that we think that calculated on a dollar per barrel basis, by using this kind of methodology to export Guyanese crude to the Far East market, I use China as a reference, it will save around $2 per barrel on the cost basis. Again, this is not an existing trade, but it's a trade that we believe is going to develop in the near future. The reason is Guyana is adding a lot of production and capacity. In just the next 3 years, each year we are likely to see a new FPSO being delivered to produce oil from the offshore oil field. Each of them have about 250,000 barrels per day of capacity. So that is a very big game changer for the crude oil tankers in the Atlantic Basin. Well, thank you very much, and this will end my tanker sections. In short, again, this is about an earning forecast that we are very bullish on the crude tankers seeing from this year to 2026, while the CBP tankers, the clean market, are likely to experiencing some of the downward pressure. Thank you very much.
Thank you. 작년에 이어서 올해에도 이렇게 열강을 해주셨습니다. 쪽집게 강의를 들은 것 같은 그런 느낌입니다. 유조선 시장 동향과 전망을 맥퀼링의 책임연구원이신 올리버 겐님께서 발표를 해주셨습니다. 선종별 해운 시황 계속해서 살펴보고 있고요. 건화물선, 유조선까지 살펴봤습니다. 잠시 휴식 시간 가지셨다가 이제 두 번째 해운 항만 세션에서 컨테이너선 시장 동향과 전망 또 알아보도록 하겠습니다. 4시 10분 정도까지 휴식 시간 가지시고 나서 다시 입장해 주시면 감사하겠습니다. 잠시 후에 안내해 드리겠습니다.